So 59% of employers who were surveyed said that they are going to make cost-cutting changes to their insurances in 2026. So they're looking at changing the plans that they offer, higher deductibles, cutting health insurance coverage altogether.
It is something that's really hard on businesses. And as you said, what a lot of businesses are doing is just not giving cost of living increases to the employees because they are saying, hey, all that money's going to the insurance.
Jamie Dimon, he just spent $3 billion building the most expensive office tower in New York, told all of his employees, you are coming back to office 5 days a week, whether or not you like it.
Once people have been ingrained in working from home, they're going to be resistant to coming back into the office. So
it's going to be interesting to see what the future of work looks like in 3 to 5 years. And I think a lot of it is more Class A, higher amenities, gyms, all of that kind of stuff.
Yeah, or a lower scale, like to save money, maybe we get a beanbag chair and a Nerf hoop.
There you go.
There you go. That'll save us from pickleball courts and basketball courts and stuff.
Nerf hoop. All right, play some tournaments. And 3, 2, 1. Jim, welcome back.
Thank you. Good to be here.
How you feeling?
Good. I wore a jacket today so I could try to meet your coolness.
Yeah, it's good.
Yeah.
Our book's here. What do you think?
I know. Well, you're an author.
Yeah.
That should make someone impressed. Is Leanna impressed about you being an author? Yeah,
nope.
I know.
My mom.
Your mom, yeah. Yeah. When my mom was alive, she was pretty excited about the book when I wrote my first book. There's a lot in there.
There is, yes. And dowealth.com/book. It's free for everybody. Audio version's in there, the full version. We're not trying to make any money on it, just trying to help entrepreneurs make rich real. So dowealth.com/book, free book for everybody.
Yeah, I love it
too.
Yeah, it's a great book. There's so much value and so much information in there. Yeah. It's like my 30 years and all of your experience and knowledge just poured into that book. It's good.
All right, well, I'm excited. We got a good topic here. We're going to call this episode the Office the Office Renaissance. And then we're going to talk through some exit planning and then also talk through some asset protection and divorce planning.
I like
something you don't really want to plan for. But let's start with Jamie Dimon. He just spent $3 billion building the most expensive office tower in New York, told all of his employees, you are coming back to office 5 days a week, whether or not you like it. I think he explicitly said, I don't give an F about the the little document that they're all trying to sign. So this isn't just about real estate, control, culture, and the future of how business gets done. So just a little bit of stats. I want to hear your thoughts here. A complete remodel here, 270 Park Avenue, $3 billion. They made this decision in 2017, 2018, continue to build through COVID, which actually, I was kind of reading the story. It's interesting. There's a lot of, right? It would have been a good time to pause construction, but he kept pushing through. So now, full RTO mandate, full return to office in-person mandate. So what are your thoughts on this Jamie Dimon telling everyone get back in town and building this huge building, and then more broadly about this return to office?
Yeah, well, I think he's doing the right thing as far as building something beautiful with a lot of amenities that would make you want to come back. Yeah. I mean, if it was a rundown, junky building, that would be less likely. So he is putting himself in the best position to get people to come back. And I understand, as you and I both do as business owners, that there is a difference both culturally and even a lot of times the work that gets done when people are in person. And from what I remember that I've seen in just psychology, that people are usually happier when they work around other people. So it's that thing where people get comfortable and they get used to working from home. They want to keep doing that. But is that the best thing for them and for the work environment? I think probably not. But I know with us, we have mostly remote people. And so once a quarter, we bring everyone to town to get together in person. And I'm glad we do that because I do think if you're remote all the time, you really do lack the relationships and the human contact.
Yeah, I mean, as Jamie Dimon says, you can't learn working from your basement. So his whole big thing is that, hey, if you want to be mentored, Gen Z, you got to come into the office. And you mentioned one thing about it's a beautiful building with the amenities. And TIs, tenant improvements, are up 68% above pre-pandemic levels to attract tenants. And that's something that I've been seeing a lot with entrepreneurs, is that the TI packages are a lot more beneficial and lucrative. And that's because these commercial buildings and office spaces are struggling to fill up their offices. Yeah. Because even there's companies like us that we've got maybe 25% of our workforce in our Scottsdale office, the other 75% is remote. And so we don't need nearly as big of an office space. Multiply that by millions of businesses, and they've got an issue. And so we do have a chart here that we're going to put up that just shows the national occupancy across the board is 52%. So that's the national occupancy of commercial real estate, specifically office space. And it really obviously ebbs and flows by city. So like Houston is up to 62%. New York City is down to 44%. This is data as of August. Law firms of all of the different industries have the highest occupancy. So it's interesting that law firms are pulling people in. Maybe it's because the associates need more kind of mentoring, but curious why law firms of all the different verticals are the ones that are doing most in person. But what are your thoughts and reactions to that?
Well, one thing that I think there's a shadow thing going on too. I think there are people who are utilizing this, for example, not to have daycare, so that they don't have daycare, they're staying at home with their kid. Well, if they go into the office, that game is over. They can't do that. So, but for better or worse, I think that is a shadow thing going on where the employer is saying, I can't have all these people who are not working because they're actually daycaring their kid. On the other hand, a worker who can get their work done and doesn't have to pay for daycare probably is resistant to that idea because they're like, I don't want to have to pay for daycare. So there are some shadow things going on. That's just one of them, that once people have been ingrained in working from home, they're going to be resistant to coming back into the office. So I absolutely see both sides of things. And that's why one thing that we've done is kind of a hybrid approach where you can come into the office, but you don't have to come into the office. But if you're running a huge company like JPMorgan, I think you probably do have to have a mandate, because if you leave it up to the employee, then you're going to just have that building you just paid $3 billion for that's going to be empty.
Yeah, but they made a strategic decision, right, to keep building and pushing through in 2020, whereas when he could have abandoned the project. So obviously he wanted to continue to invest through the cycles, which I think is what he's quoted as saying at JPMorgan, we invest through the cycles. But I think the point that you have, if the employee's at home and they're doing their job, my opinion is that it doesn't matter whether they're in the office or not. I do think there is something biologically, we're herd animals and wanting to be in the office. I think there are just some benefits there that can't be replaced. Mentorship and just hearing people next to you and how they're solving problems and going out to lunch or coffee. But I also think that, hey, if someone is hitting the metrics, and sometimes I think it's easier for a company to just say, hey, everyone go back to the office, then put in the systems and the processes to be able to measure and define success clearly. Because if a company can clearly define success in terms of the outcomes, then the inputs shouldn't matter, right? All that matters is the output. So that's kind of where I land on that piece.
Yeah, I'd mostly agree with you. I do believe that most people grow more, learn more when they're around other people.
Yep.
As you said, mentoring. I mean, that's a huge thing that's so hard to get through Zoom calls. There's just a part of being in the office that doesn't change. In this particular case, I think you cannot invest $3 billion into your company and then have 50% occupancy in your building. So for that reason, I think he's really driven to force people to come back. And you know, he has a point. As long as he can handle people who are leaving, which he's made very clear, go get a job somewhere else if you don't want to come into the office. And on the other hand, I think he will attract some people who are forced to work remotely, because there are those people who work remotely and they would love to come in the office and be around people more often. They just don't have that option because some companies have just closed down their offices.
Yeah. I mean, and even as we hire remote employees, it's always a question I ask for someone who was going in the office of, are you prepared to actually work from home? And there's been some conversations where I say, I don't know. And it's like, you know, I think maybe that this may not be the right fit, because I don't want you to get lonely and then you're depressed, you know, just because, yes, we'll fly you out every quarter. But for some people, tribal animals, I know I couldn't work remote full time. You know, I like the flexibility, but I'm in the office 4 days a week. So
yeah, me too. I'm like you. If you said I have to work home remotely forever, I would never want to do that, because I give up so much of the human interaction. On the other hand, if you said I can never work from home, I'm not sure I would like that either.
I totally
there
agree.
are days that I just would rather, you know, put on my dress shirt and a pair of shorts, right?
Yeah. Well, I'm glad you're wearing shorts. So I think some takeaways for business owners, you know, make sure you're pushing for TIs, because I think the TIs, and as I look forward at the office space, if you think of it, if you're a landlord, you're struggling to attract new tenants. As we talk about the occupancy, you know, it's at just over 50%. Now, Austin's very geographic dependent. So Class A buildings, this looks like 74% occupancy versus 52% overall. So there's obviously the premium office spaces. And I think that leads into, as I think through the future of us from a real estate perspective, I would rather go smaller and rather go higher end, better amenities, better features. So when people are, they want to be there, they're drawn and they're attracted to it. But we got too much real estate right now that I'm excited for our lease to roll off. And I'd rather go higher end, more features, more amenities, but less square footage, and then just fit it within the same or smaller kind of monthly cost envelope.
I agree. And multi-purpose.
Yeah.
If we can use the office for more things than just offices, and if we can have more like stations where people work, and right now you and I have our own office, and I can have a picture of my mom at home. I don't need that, and that would free up, if we have flexibility, dovetailing better with the actual experience of the workforce that we have.
Yeah, a few entrepreneurs I know, they, as part of this, they've actually are like building like gyms, big gyms, and build outs into their, they're like carving what was some office space, and they're repurposing the building that they own. And they're like, all right, we have all this dead office space. What can we do? One I know, they had an indoor basketball court, pickleball. Some of them are building like, full weight floors and gyms, saunas, cold plunges. So it's just interesting to see the repurposing of some of the space, especially if they own the real estate. And they have all this empty office space because they're gone hybrid. They're repurposing it, and that all just goes to TIs, improvements, and then it just tries to get the people who do come into the office to have a better experience, to commingle, and to just interact with each other in different ways.
Yeah, or a lower scale, like to save money, maybe we get a beanbag chair and a Nerf hoop.
There you go.
There you go. That'll save us from pickleball courts and basketball courts and stuff.
Nerf hoop. All right, play some tournaments. All right, so JPMorgan's betting $3 billion that their people will show up. Let's talk about what happens when entrepreneurs don't show up for a difficult conversation. So that's a good transition there into a conversation I've heard from different entrepreneurs about asset protection trusts versus prenups. And I've seen this multiple times now where some entrepreneurs don't want to have a difficult conversation with, generally tends to be a second or third spouse, generally not a first spouse, but they'd rather, in a way, lawyer up instead of having a conversation about a prenup. And so just to set the stage here, I think that there's some emotional discomfort when you lean into a conversation ahead of a marriage that's like, hey, maybe we should talk about having a prenup, because it can be construed as, oh, you're expecting this marriage to fail. And I think that's a block that some will overcome. But there's also a business planning angle of this, an asset protection angle of this versus just marriage planning. And so, again, I've heard multiple entrepreneurs that say, hey, how about I just don't have that conversation, and then maybe we just create some asset protection trusts or move some assets around to protect me in a different way. So what are your gut thoughts?
Well, the first thing is Mimi, we've been married for 33 years, and I like to tell her that, I should have had her sign a prenup. And she goes, we were both broke. And I go, no. You were negative broke, because she had debt. So if I would have, done the prenup, maybe I wouldn't be responsible for her debt. The truth is about prenups and asset protection trusts, sometimes the answer might be both. Mm-hmm. But what I tell entrepreneurs about this prenup conversation is they usually have it too late. Mm-hmm. And I say that the time to have a conversation with someone you're dating about potential prenup agreement in the future, and we should say a prenuptial agreement is an agreement before you get married, so that the assets that you bring to the marriage are yours. If you get divorced, of course, things you create together, those can be split. But what you bring to the marriage, you get to take with you when you go, so that you don't have a spouse taking what you built without that spouse. That's kind of the idea, right? So the time to have that conversation, I jokingly say second date. First date would be weird, second date. Mm-hmm. And I say that only a little bit kidding, because typically entrepreneurs that I talk to who get painted in a corner, they wait till they've been dating a year or two and they're about to pop the question. And then it's going to seem like you don't believe in the marriage, you think it's going to fail, you don't trust me, all those things. If you do it at the second date, and the way you bring it up is not, I want to marry you, but, oh, if I ever got married again, I would sign a prenup for the other person, have them sign a prenup, and just tell them like how you're thinking about things. And if you do that very early in the dating space in a way that's not creepy, then that person, you're going to find out right away. If that's a person that's probably a long-term relationship person, they're going to go, hey, I don't care about your money. I'm with you because of you.
Yeah.
And that's how you introduce it early. If you wait until you're about to get married or about to ask the person to marry them, then it comes out of the blue and it seems like you are betting on the marriage failing. So that'd be the first thing I'd say is you need to bring that up very early in any kind of relationship that you might think it might get serious, rather than waiting until it gets serious and expecting that's not going to create a problem.
Yeah. Well, I think too, as a successful entrepreneur, then if you're unable to have a conversation about the prenup, I think that could be a precursor to bigger communication issues that are in your marriage.
Definitely.
And so I think that someone who sees and respects what you are working on, what you're building, and they want you to be successful, there's going to be a lot of trade-offs that happen within that marriage anyways, because being a business owner is not a 20, 30, 40-hour a week job. I mean, it's constant, nonstop, as you and I know. And so I think that the right partner should support you in all the different ways. And I think protecting your life's work should be expected, not a
Absolutely.
compromise.
And you can tier these things in. I mean, there's multiple ways to create these, and I've seen them crafted where it's like, hey, if we're married for 10 years, then I've even seen that with very wealthy people who they'll say, I'm trying to think of a couple famous people that I've seen these prenups where, the person might be worth $400 million. They say, hey, if we're married for 10 years, you're going to get 20 million if we get divorced. If you're married for, and they tier it out so that as they go farther and farther in life, often that very, very wealthy entrepreneur goes, hey, I don't want this person after 20 years to be left without a tremendous lifestyle that they have grown accustomed to. And those details can get worked out. But back to the thing about prenups versus asset protection trusts.
Yeah, and I think too, just practically speaking, if both spouses are bringing in some assets, or even one spouse is bringing in assets, create a separate property revocable trust. So that way it's very clear all of the premarital assets go into these separate trusts. There's no inherent asset protection. Name those trusts in the prenup, right, not to be touched. And then once you get married, you have a joint trust, or you can, commingle assets in whatever you want. And then that's what would get split, however you kind of decide. But I think that's a very easy, practical way to keep everything segregated. And then that way it's very clear. And so the other thing is, as I think through and just looking at how to the ultra 9-figure and plus, net worth entrepreneurs handle this, there's definitely separate property trusts and entity structuring that's combined with the prenup. So that's kind of the planning that's done on the front end. And then it's important post-marriage to document the separate property trust maintenance, not commingling. I think that's very important. And then also even, incorporate within the operating agreement different first right of refusals or ROFRs, transfer restrictions, just making sure that you kind of have the extra layers of defense just in case the prenup, just in case the property trusts are pierced. You have then also these governing legal documents as kind of a last line of defense. So we do have a chart here that just kind of talks through the billionaire approach of how to layer these different strategies that we'll throw up for others to see. So speaking of layer strategies, let's talk through an actual case study here. So know an entrepreneur here, $50 million is the net worth. And kind of what they did was they kind of did this. I shouldn't say kind of, they did do this. Now, it was really also an estate tax play, estate tax mitigation play, and then also a income tax mitigation play. So this entrepreneur is in mid-40s, about $50 million net worth on his second marriage. The second marriage was done probably within a month of the divorce getting finalized, since those divorces take a long time, especially if they're not clean. He didn't want to have the prenup conversation. So what was done instead, he was telling me about, is he was based in Kentucky, which is a 4% income tax state. They sold assets to a Nevada trust. And so the idea was that all of the growth of these assets is now outside of the taxable estate, because if he passed away with over $15 million in 2026, all of that growth is subject to taxes. Anything above $15 million is subject to 40% estate taxes at death. So sell the assets to a Nevada trust, and then also avoid the Kentucky 4% income taxes when there's some closely held business units that he was a minority investor and that he thought were going to pop off. So the idea here was that he doesn't own any of these assets. He's owed money from the trust because he sold all these assets into a trust. So that was what he did. I think maybe a prenup would have been a good first step conversation instead of all this planning. Now, it was estate planning and income tax planning too, but what are your thoughts on that kind of structure? And then also maybe the guise of estate tax mitigation and income tax mitigation, which is true, but also maybe omitting that this is also a prenup avoidance technique.
Yeah, well, I'm always a big fan of communication, even when it's difficult, and especially in the most intimate relationships, which would be between spouses. So I would never advocate that you should go with a plan where you don't have to tell your spouse the truth.
Yeah.
But in this particular situation with this person where he didn't want to have the conversation, wanted to protect his assets, this is a structure that would work in that way and also gives him asset protection and estate planning and some tax benefits. And for those reasons, I think, those are reasons to do all of that. I think this also dovetails into people with kids from a second marriage, because often I've seen in my career where one spouse dies who has kids and the other spouse survives, and then all of a sudden the kids are upset, the second spouse is upset. Like everyone, you create these family rifts where everyone's angry at each other and doesn't talk anymore. And again, that's where communication happens. And what a lot of times, let's say a man left his wife and they had kids together and then married someone else and then never wanted to have a conversation with the kids because he felt uncomfortable, and he never wanted to have a conversation with his second wife, and she just assumed everything goes to her. And then when he dies, everyone's angry.
Yeah.
And of course, The smart thing to do is when people are of age and they're mature, whether it's the kids or whatever, is to actually sit down with them and having real conversations about, here's how I look at it, here's how I think about this is my money and this is the way it's going to flow. And if you have a problem with that, let's talk about that right now. And if you do that while the person's alive, you can mitigate a lot of these problems, because once someone dies, then each side thinks that the person who died would have wanted to take better care of them.
Mm-hmm. Well, I mean, Warren Buffett says, right, that no one should be surprised by a will. And I know he talks about that with going through with his family.
Yeah.
Every single year, here's exactly what's going to happen to my money. So I think that's just the important piece about estate planning. And just recently, there was an article in the Wall Street Journal about, wealthy families doing mission statements and value statements. And we're seeing a lot of that and helping our entrepreneurs craft a lot of those documents to complement the actual legal documents that are legally binding. Because at the end of the day, it's all about communication. I mean, that's what's successful to a successful marriage. Important to a successful marriage is the communication, but it's also important to the intergenerational transfers.
Yeah, and a lot of times kids and grandkids, they just assume the way it's going to go down, or surviving spouses. And I know the grandson of a billionaire who is frustrated because all the money is locked up in trusts. Mm-hmm. He can't get it. Now, he gets it for certain reasons. He can apply for it for certain reasons. But his thing is, well, this is my inheritance. Why can't I just have it and use it the way I want to use it?
Right.
And of course, you can see the billionaire at the top level saying, well, I don't want to do that. I don't want to just give my grandkids a bunch of money. So they, as I think Warren Buffett also said, give them enough money so they can do anything, but not enough so they can do nothing. And yet you can see that disconnect, that there was no communication about, like, here's how it's getting set up. So if you think all of a sudden you're going to have this money and do whatever you want, that's never going to happen. However, there will be resources that will help you in certain situations.
Yeah. I mean, again, failure of communication, that even for that billionaire, there should be values or mission statement or something accompanying the document of, here's the intent of this trust. Here's the intent of when and how you can get money out. Here's what I'm trying to incentivize you. Here's what I'm trying to protect you against. Because if he had a drug or addiction issue, right, then hypothetically you could have full access to the corpus of the trust, spend it down, and then it would just further compound his issues, which is probably what the billionaire patriarch of the family was trying to prevent.
Definitely.
Was accelerating the abuses.
Yeah. And what happens with human beings is, if you don't know the answer, you create a story.
Yeah.
And whether it's the spouse, the second spouse, the kids, the grandkids, they're going to create a story. Right. And they're going to blame someone, and a lot of times they're going to claim to be a victim. And then you have this discontent in the family, which is a mess.
Yeah. Well, let's talk through the structure. One of the trusts that was set up here was what's called a NING, a Nevada Incomplete Non-Grantor Trust. And so that was what was used to specifically get around Kentucky's 4% income tax rate. The idea being some assets that were moved into that trust were minority interest in companies that were expected to have huge liquidity events, so not necessarily an operating business. And so the idea being that when those sold, the entrepreneur no longer held those. They were owned by this trust that was domiciled or based in Nevada. Nevada does not have a state income tax rate. So therefore, when there was a capital gain event, still pay your federal capital gain taxes, but you would avoid the 4% on the Kentucky side. So the projection was going to be over 6-figure tax savings just based off the valuation and the appreciation. So what are your thoughts on NINGs overall? And just as that was one of the kind of actual technical strategies this entrepreneur used.
They're complicated. You obviously want to have good counsel on that, but they can be really effective just for the reasons that you said. And I've seen entrepreneurs take stock from a company that's growing fast, put it in a NING so that some future date when that company sells, just like you said, you can avoid the taxes. New York actually passed a law to eliminate the ability to do NINGs. California, you can still do them. California is very aggressive in their attacking them. So the longer you have, as we like to say, those trusts to marinate, the longer time you have that those trusts are in existence, the more likely you're not going to have a problem. But, a lot of states have state income tax and capital gains tax, and this can be an effective way. And not only that, asset protection, as well as estate planning. And I've seen entrepreneurs use the proceeds to create almost like a family bank that can be used to loan money at good rates to the kids and grandkids, and also teach financial responsibility without all the things that you have to do when you go through a regular bank.
Yeah. Yep. And I think kind of transitioning back to the prenup and the whole conversation about marriage, the question would be is, if there were issues in this marriage, would the new spouse argue that there was concealment of premarital assets, which could kind of null and void this, or even make an argument there's a fraudulent transfer and the court could maybe hold them in contempt. So it'd be interesting to see even like legally, which is outside of my bailiwick here, is how legitimate the structure could actually be if there were issues within the marriage, ahead of this whole structure getting wound down. But I do think that the argument from the attorney is that this is an estate and income tax, mitigation strategy more so than a...
Yeah, and if it's truly that, why not do it as soon as that benefits you and not wait till you're about to get married?
Yeah.
And when I think the bottom line from all of this is make sure you marry the right person, make sure there's a lot of communication.
Yep.
And I think it was your dad, if I could share that, your dad gave you a couple bits of advice for your life.
Mm-hmm.
What were those?
Yeah, I remember it was like an article, I think that was published in like the late 80s, early 90s, and he like had it cut out. And whenever we would graduate from college, he would give it a copy to each of me and my sisters. And it was like, essentially said there's two decisions that if you get right in your life, you will be happy. The first decision is going to be your career. And so essentially you're going to spend, half of your waking hours in your career. So getting that decision right is so critical. Second, the biggest decision is your spouse. So he pretty much is like, if you marry right and you choose your right profession, you're going to have like 80% of your life has been figured out. And I think it's really true because one house, one spouse, that's another great financial saying that I love to say. But I do kind of back to that comment. I think that getting into the right career and choosing to marry the right person is definitely the most important.
Yeah, and I think you and I did very well in that space. Now, Leanne and Mimi, I'm not sure they would agree that their decisions were best. But yeah, I mean, that's, as much as that sounds cliche, really marrying the right person is so important. And it's also why when you marry young like we did, or like you did, when you have nothing, it makes the whole thing much easier. You still want to marry the right person.
Yeah.
But there's not all this complexity. But the reality is there is that complexity. And that's why earlier in the podcast I said, have that conversation early in a relationship. See where you stand and how you can figure that out together rather than waiting until you feel like you can't bring it up.
Yeah, and I think there's it'd be interesting to see if there's a correlation between wealth and divorce rates. Because I do think that as I look to the ultra, high, the Bezos, the Gates, marriages tend to fall apart there. I mean, I think there's some exceptions to that rule, like Zuckerberg, but even Buffett had a lot of marital problems. And so I think it's interesting that if ambition and I think maybe distraction and not being mentally present in the marriage is probably what I would guess is like kind of a byproduct of maybe someone building a business. Elon Musk, right? Huge marital issues, been married several times.
Yeah. I think the best indication or the best story I can think of is Jack Welch, who was the famous CEO of General Electric and took them through the most incredible years and wrote a book called From the Gut. And yet, as smart as he was and as much as he did, he got divorced. And when he got divorced, it cost him something like $500 million, about half his net worth. And I just thought, if he would have been a little more focused on the relationship, maybe he would have had a better life and a better net worth. Yeah. They both can work out for you if you're paying attention, not just to the business, but also to your home life.
Yeah. I mean, people are worried about market downturns, but quickest way to lose 50% is to get divorced.
Yeah, absolutely.
Not only do you lose 50%, but your expenses also increase. Now there's two houses. There's double of everything. So
Yep. Not to mention your stress.
Yep. All right. Well, let's talk through. I want to transition here to the M&A market. So I saw some data came out that's a little bit delayed here, but it's about the first kind of 6 months of the 2025 is in the book. So there's been some good data here. And interesting, I want to break down that the glut of businesses is stacking up here. So volume is down 14% year over year. And smaller transactions, with meaning less than $10 million of enterprise value, are down 18%. So this is just showing that as interest rates have gone up, there has been a slowdown in M&A activity overall. But what's interesting is that valuations are actually holding strong. And so what that's saying is that if you are a well-run business, people are willing to continue to pay valuations that are at the higher end of the historical range because the valuations aren't moving down, but just the sheer number of deals getting done is smaller. So what are your thoughts overall on just kind of some of this data here? And we got a chart that shows the historical M&A volume, and it's overlaid with the Fed funds rate just to kind of show that maybe as interest rates go up, historically transactions have come down a little bit.
Yeah, I think that's normal. Cost of funds and all other types of reasons why you're going to have slower and less transactions when you have interest rates go up, especially as dramatically as they went up most recently. And yet, on the other hand, there's so much money in the wings. There's so much cash looking for a home in the M&A world, just like there's so much cash anyway. I mean, you look at the cash on the balance sheets of Americans, it's a huge number. It's into the trillions. And because of that, that money's looking for a home. So in the M&A space, it makes total sense to me that the well-run companies are still going to demand a significant premium or a valuation that's warranted. They're not going to take a hit there because this money is looking for a home.
Right.
And if you're one of those well-run companies, you can expect a really good price.
Yeah. I mean, so middle market's defined as less than $500 million here. This data is all from Percent, which Mark Herbick there, a good friend. 7.2x EBITDA is the middle market average valuation, up from 7.1x in 2024. And then bigger companies deserve a higher premium. And so we've got some data here that if it's a $10 to $25 million total transaction, the average EBITDA is 6.3x. $50 to $100 million, it's 8x. And then $250 million to $500 million, it's a 9.7x. And that really just, think of finance risk return as the way I like to describe this to entrepreneurs. The lower the risk in your business, the more that business is worth, because you are taking risk off the table. So therefore, someone is willing to pay a higher price, because at the end of the day, someone needs to get compensated for the amount of risk they're taking. So if your business is very poorly run, if you can even get a deal done, it's going to be at a lower valuation, because if it's successful, the buyer needs to make sure they get a huge return. How do they get a huge return? They buy it for less money. So we're seeing some data there. And then the other thing I want to just talk through is EBITDA range. So that was based off of the total enterprise value. But if you're a $3 to $5 million EBITDA, 6.6 is the average. Again, this is very industry dependent. $5 to $8 million, 7.4x. Over $10 million, 8x. So again, huge disparage range here based off of the industries you're at. So healthcare, business services on the higher end. If you're in construction, anything like that, you're going to be a lot on the lower end.
Yeah.
So
CPA firms,
those
are on the lower end too.
So we've got some charts here, chart 2, chart 3, that we're going to throw up that just shows the data here of where we're pulling these figures. So what are your thoughts on just valuations overall holding steady, and then really valuations by EBITDA range?
Yeah, I think it makes sense. And I think the bigger you are, the more you're worth generally. And your point, which is really the key point, is risk.
Yeah.
And that's why entrepreneurs who their business is too dependent on them, too much risk, right? Something happens to one person, and that's not just hit by the proverbial bus, but maybe you're going through a divorce, back to our prior conversation, or you have a health problem. So you rely on one person, there's a lot more risk for that buyer. And then also things like reliable, predictable income and being able to project your future. So I know I've given talks about P&Ls and about having a model P&L and about budgeting, and that the more you can show that you can predict the future and then make those numbers come true, the more likely a buyer is going to go, okay, well, you've proven that you can rinse and repeat this profitability margin, this profitability and growth train. So I'm willing to pay more because I have confidence that my risk is low, that's not going to disappear anytime soon.
Yep. All right, let's talk through how these deals middle market deals are financed. So generally within private equity, the way that they're going to finance the deal, and it depends on the industry, but they're going to lever you up, put some debt on there, and maybe 30 to 50% of the transaction price is going to be financed through debt. So again, the buyer is going to go grab some debt, and then the rest of it's going to be through equity infusion. So when we're looking at some of the numbers here, the average debt was 3.1 times EBITDA. So for example, if they bought your business for, let's say, an 8x multiple, 5 out of that 8x is going to be equity or cash. The other 3 is debt. So that's how they're financing the purchase of you. And the average interest rate was 8.1%. So what that means, and that kind of then ties the loop of why and how interest rates impact valuation, and why valuations were so high in 2020 and 2021, because these private equity companies could essentially borrow money at 4%. And so as long as you could get a higher rate of return of essentially that 4% from operating this business, why would you not just take on a bunch of debt? So then therefore they'd be willing to pay more. But now as interest rates have gone up, it's a higher hurdle rate that they need to clear in order to make money on these deals. So again, 8% is the average interest rate that these PE firms were borrowing at in the first half of 25. And then 3 EBITDA turns was the average amount of debt that they're putting on there. So I know we've seen some business owners levered up as part of these deals. There's some risk there. Maybe fill in some entrepreneurs on some things they need to be thinking about if they're selling to private equity, and understanding the cap stack that the private equity team's coming in.
Yeah,
with.
and one good point about this is the reason why there are fewer deals. Because if all of a sudden you're going to be borrowing money at a much higher interest rate, you're going to be much more careful about when you make a purchase.
Yep.
As opposed to if your interest rate is so low, 3 or 4%, then you are going to do more deals, because if you're wrong, you don't have as much of that debt service that would come into play.
Yeah, and I know that there's I've seen multiple entrepreneurs that were bought out by private equity companies. They lever the debt on. This was really happening from deals that were struck in 2020, 2021, and we actually have a chart here that shows the increase in interest rates. The senior debt interest rate, which was 6%, got down to 4% during COVID. Spiked to 11% in 2023. This is all floating rate debt. So if they were underwriting the model at carrying the interest at 4.5%, now you're running a business, you've got to pay based off your operating business, you've got to pay this debt service back and based off your debt service coverage ratio. And then if the interest rates are going up by 2.5 times, not 2.5%, but 2.5 times, then a lot more cash is going out the door just to float the debt. So that has caused multiple bankruptcies where the private equity companies over-levered the acquisition company, put too much debt on it, interest rates balloon up, they can't afford the debt, banks now foreclose on assets.
Yeah, and if you're listening and you know real estate, that's pretty much the recipe of what happened with multifamily in the last few years.
Yeah, nope, spot on. Last chart we got here is just going to be the EBITDA turns of senior debt multiples in blue. And then also there's something called mezzanine debt, which is just going to be extra debt that's going to be generally unsecured. And so this is where there's a lot of private credit lending going on the investor space. A lot of that is really the flip side of this mezzanine debt. That yes, there's a borrower there, which is going to be generally a company that's getting bought out, but you're usually second in line to get paid back. 12.1% is the average interest rate there. When you include warrants and payments in kinds, PIK, 16% is the total cost of this mezzanine debt. So that because it's going to get paid out in a default scenario after the primary debt, because they get what's left over, they have to charge a lot higher interest rate to cover themselves because of all the extra risk that's being included on here. So interesting just to see that.
Yeah, this would imply that as interest rates go down, we'll see more deal flow and more deals happen. Would you agree with that?
Yeah, I would agree. I think there's the other variable there is what's taking interest rates down. If it's a macroeconomic pullback and then there's issues with the consumer, then if you're a CPG or some sort of brand, you may face headwinds, right, from your own industry. But yes, if it's just kind of a traditional rate cutting cycle, which we tend to be in now with unemployment still holding strong and inflation not too high, then yes, that just decreases the cost of capital. That'd be good. But there's also some people that I feel like are rooting for a recession just so interest rates go down, but no business is really doing that great in a recession except for maybe the mortgage brokers who are refinancing everyone's 6 and 7% mortgages.
Maybe the alcohol companies when more people are drinking.
Not with imports not with all the tariffs we got, right?
We'll see.
Suburban.
I think there'll be an end to, at some point, there'll be an end to this tariff talk. I'm hoping anyway.
Speaking of, completely off topic, but I was reading an article that the Napa Valley region is just, consumption is going down, price per acre plateaued, it's coming down. They're just dumping wine in the streets, so to speak. So, and there's a lot of, and even I think I see a lot of my personal stuff. I got a Whoop now. I track how my recovery after alcohol, my consumption's way down. So even like Napa Valley, once like untouched golden value of land is getting hit.
Yeah. Funny you mentioned that. There was an article, I think it was also in the Wall Street Journal, about Sonoma. And what Sonoma was going to put into effect was a tax on all the wineries. And then they were going to take that tax money to do marketing for young people to drink more wine.
Oh, wow.
And then there was this big pushback from all the winemakers, like, we're not going to pay a tax so that you can market to younger drinkers. And what the county was saying, no, this is going to help you because we need to get more wine drinkers and we need to go after the younger population. So anyway, that one's on hold right now because there was such big pushback from the wineries. And the whole thing was sales are down, but we're also going to tax you more, which is going to be really hard pill to swallow for those producers.
I wouldn't trust the government to run my ad budget.
Absolutely right.
Interesting. All right, well, buttoning up this topic. So again, business owners, if you're selling, if you are a well-run business, valuations are holding steady. I know we're going through multiple transactions with clients right now. The valuations for these well-run businesses, north of 5 million EBITDA, looking really good, right? High single digit, low double digits, but they're very well-run businesses. So if you are not a well-run business, the heyday of 2020, 2021, and you think you're worth 8 to 10x is gone. Your business is probably not even sellable. So start working on building that enterprise value.
And by the way, this is a good motivation to get your company where it runs well. Because whether you're going to sell it or you just want to have a better life and make more money, having a well-run business checks both those boxes.
All right, well, let's transition here into talking about what your business is worth to something that can destroy your business from the inside out, employee benefit costs. And this is something that from the fractional family office floor here, just a segment where we like to just talk through what are we doing within our business. Our health insurance renewals came back, 17.5% year-over-year increase. Before we went live here, I was talking about another entrepreneur who's paying over $2 million a year in premiums for their whole company, over 300 employees, and it's a 70% year-over-year increase. So this is the new normal, and it's about to get worse. So we've got some data, but I know when we got sticker shock, we pay the full premium for our employees. We subsidize if their family's on our plan too, but this is turning into a bigger and bigger line item in our P&L every single year. And I got some data here that just shows that the average employer is seeing an increase in 5 to 9%. Which doesn't actually sound too terrible when you look at 17.5%, but I felt better when I was coming in at 17.5% when I was hearing some of these others at 70% year-over-year increases. So something's broken here with this, because it's weird that business owners now are the ones that are expected to pay for all of this health insurance. And there's a lot of stagnating wages, but then if you actually look at the data of cash compensation plus all of these benefits, it actually is tracking with inflation. So yes, cash compensation hasn't held up, but the actual issue is our insurance, and really that goes into our medical, and there's just issues societally here with the cost of medical coverage.
Yeah, and by the way, our clients get cost of living adjustments every year in addition to the health insurance. One of the problems with this is for an employer, employees don't really see this as a big deal, right? Like if your premiums go up by 17%, no one's telling you how great you are for covering their health insurance. So it gets lost in that translation. And I remember one time a very smart person in this space told me years ago, the biggest mistake our country made on health insurance was tying it to the business.
Yeah.
So the employees get insurance at the business rather than having it like car insurance where it's a direct from consumer. But whether you could debate that or not, it is something that's really hard on businesses. And as you said, what a lot of businesses are doing is just not giving cost of living increases to the employees because they are saying, hey, all that money's going to the insurance.
Yeah, I mean, 17.5% is crazy. So 59% of employers who were surveyed said that they are going to make cost-cutting changes to their insurances in 2026. So they're looking at changing the plans that they offer, higher deductibles, cutting health insurance coverage altogether, and then some variables that are driving this. So specialty high-cost drugs, so GLP-1s for weight loss, that's been attributed to adding 1% alone in terms of like inflationary growth because so many people are on these GLPs. Mm-hmm. And so interested to see if President Trump can actually implement this most favored nation negotiation strategies that he's talking about, because yes, as Americans, we are definitely subsidizing the whole world's consumption of our pharmaceutical industry. And is it fair for us to be footing the bill for the R&D of the whole world? I don't necessarily know if I agree with that. Catastrophic claims are increasing, like cancer, those are huge out-of-pocket expenditures. Healthcare providers are consolidating, so they have more pricing power. So they're acting more and more like monopolies or duopolies. And then also post-COVID utilization surge. And so a lot of people weren't going to the doctor for a while just because of the issues. And now there's kind of like this backlog of kind of stuff that people were feeling. It's kind of what some of the experts are saying. And now all of that's getting kind of pushed through. So these were some of the drivers, it looks like, of what's pushing these costs up so much year over year.
Yeah, it's a big issue. And I remember a few years ago here in town in Scottsdale, Mimi and I were at a steakhouse, I won't say the name, and when the bill came, there was this charge on there, I think it was 7 or 8%, and it had this very cryptic explanation, a line item. I was like, what in the world is that? So I called over our server and I said, hey, what is this added fee here? And he goes, oh, well, that doesn't go to me. That was the first thing the server said. And I was like, okay, well, like, what am I paying for? He goes, I don't know, but it doesn't go to me. I'll go get a manager. And the manager came out. And I said, what is this? And he said, oh, that's to pay for the health insurance. I said, whose health insurance? Our servers, our cooks. It goes to pay their health insurance. So then I called our server back and I said, this does go to you. This helps. This is paying for your health insurance. He goes, no, it doesn't go to me. I go, it pays for your health insurance. He goes, but that doesn't mean it goes to me, which shows the disconnect. Well, it turns out 6 months later, there was a class action lawsuit against the steakhouse because you can't do that. You can't just put a line item to pay the health insurance for your employees and make your customers pay for it, evidently. So they took that off. So I've been to that place since, and they don't have that line item anymore. But I thought, in a way, that's creative.
Yeah.
You know, I also felt in a way it was dishonest, like to slip that in there and to hit me with it. Like, just raise the prices of your food.
Yeah.
I'm fine with that. But putting something in there, and then, of course, the servers don't feel like that, you know, I still have to tip 20% or they're going to be mad at me. Right. And yet that's getting their health insurance paid for. So anyway, that's how far the problem, how deep it goes.
Should we debate now on, do you tip on pre or post-tax dollars, or is that too messy of a conversation to have?
If Mimi listens, luckily Mimi probably won't listen to our podcast. She hears me enough. But yeah, you look it up anywhere you want. You should not tip on tax.
I'm with you.
No tips on tax. Because then,
you.
And my running joke is, you know, if you're in a jurisdiction that has a higher tax on food or on whatever, then all of a sudden you pay more to the server. That makes no sense. Yep. And I've never gone into a restaurant at the end of a great meal said, hey, I just want to thank you for how you handled the tax tonight. It was incredible. It was done perfectly. It was delivered perfectly. Thank you for the tax. I'm going to tip you on that.
All right, well, let's talk through back to insurance. So in 2025, the average all-in employer cost was over $16,000 per employee. Employees on average contributed 21% of premiums on average. So like I mentioned, we pay 100% of the premiums for our employee. If their family is involved, we just subsidize the rest there. So yeah, definitely very interesting data here. The total employer cost is about $4,800. And so the $16,000 number there is just like the all-in cost of the insurance between the employee and the employer. So what are some entrepreneurs doing, right? Increasing the deductible. So going to HDHP plans, high deductible healthcare plans, pairing those with HSAs. I know we love those, just more so from a financial planning perspective. HSAs are amazing. I know we talked about that.
Yeah.
Narrow network plans, increasing cost sharing, wellness program incentives to reduce utilization. That's a big thing that I'm actually seeing a lot of with bigger 9-figure businesses. And then they're moving a lot more towards using captives and self-funding a lot of these plans. And so like the client there, or not the client, but the entrepreneur that I was giving you that example of spending multiple 7 figures on insurance premiums, they're going with a captive approach, which really means that they're just self-underwriting this, building up of reserves, and then they're also then more incentivized to roll out wellness plans because it's all based off of the actual utilization. And so there's like an actual alignment there. And then those tend to be the same businesses that are rolling out gyms, they're rolling out blood panels, they're doing a lot of offensive healthcare work to help reduce those chronic health issues, because now they're saving dollar for dollar on what's not getting paid out.
Yeah, the preventative stuff. That's really smart.
Yep. So you got to get to a certain size. I think 100 employees is kind of the rule of thumb before you should start looking into those, where the premiums start making sense. But it can also be a nice little tax play too. If you have positive underwriting, then you can actually profit, quote unquote, some of the underwriting there.
It's such a big problem, and I hope that someone will disrupt the healthcare system in a way that helps us, because I don't see the government fixing this. Unfortunately, a government just likes to spend more money. They don't like to fix the problem. We've got all kinds of problems in our healthcare and especially health insurance industry. It's really tough.
Mark Cuban, he's doing cost plus drugs. I don't know if you've heard of that.
No.
But former Dallas Mavericks billionaire,
I know
cost
who he
plus
is.
drugs. And I think it's like cost plus 10 or 15%. And it's actually interesting. I've listened to some podcasts about how he's doing it, and he's running into huge issues with the PBMs.
Yep.
Everyone's trying to box him out and not allow him because he's very transparent. And so, if he can't do it, I don't know if anybody can. But yeah, hopefully this administration can help loosen the rules and allow some more competition, because we're the ones who are paying, for this. And
100%.
I don't think we want to turn into Canada and have 6-month waits to get MRIs.
No, and unfortunately the key is, and a lot of times when you talk about the broken healthcare system, one of the reasons it's broken is it's like the old the cartoon that was written, I don't know exactly when, but it was based off of a quote from the War of 1812. But I've seen the enemy, and the enemy is us. I feel like part of the problem with healthcare is the fact that as Americans, we're not healthy, and people are not taking care of themselves. So yes, the system is broken, but we also have to get healthier. And that's the preventative stuff, the eating better, the exercise, all those things that go into being healthier.
Yeah.
And unfortunately, people aren't doing that across the country, and that creates a lot more health problems in older years.
Yeah, I mean, there's definitely structural issues with the protections that are put in place against the pharmaceuticals, and they have incentives and all that kind of stuff. But I love the idea of, what if we just tripled the amount that people could contribute towards their HSA? And then what if like gyms and all of these different things that we know are better for people can be written off using pre-tax dollars like HSAs? And so just broaden the use of that tool so the government helps subsidize it by allowing those HSA contributions to go up. And then anything that's involved with health and wellness can be written as supplements, etc. I mean, of course, you'd have to do some anti-abuse, but that just makes a lot of sense to empower people to make their own decisions instead of going through an antiquated system.
That makes me think of one thing: Bryce for president.
Okay, let's start it.
Yeah, let's do it.
I don't know what year. I'm not quite 40 years old yet. We got a ways to go. But.
Yeah, well, based on the way we've seen presidential candidates recently, in about 20 years I'll run.
Yeah. We're ready to put you out the pasture now. I don't know about 20 years.
I know.
All right, well, that's all we got here today. Jim, what's your biggest takeaway? We talked about a lot of good stuff today.
I think my biggest takeaway is on the M&A holding steady with pricing.
Yeah.
Because as an entrepreneur out there, I think a lot of entrepreneurs are worried like, hey, if I sell my business, I'm not going to get full value. And that's not true. If you're running a great business, there's still a market for that.
Yeah. No, I like it. I think my biggest takeaway, I was actually going to talk through the M&A market. I like that one too, but I'll talk to the RTO, like the return to office. It's just interesting to see every company has a different strategy. We have a strategy obviously of just being flexible and allowing full flexibility, but it's going to be interesting to see what the future of work looks like in 3 to 5 years. And I think a lot of it is more Class A, higher amenities, gyms, all of that kind of stuff, and there's an office building here that was just completely redone, the Bond building here in Scottsdale, and it's beautiful, and they got gyms and restaurants and recovery rooms and all that stuff in there, but they filled that building up very, very quickly. And so it's been, I was like, this is the future of work. In order to get people to show up in person, I think you have to like kind of roll out the red carpet, which means that landlords need massive TIs to subsidize these build outs to get these companies in, or else I think they're just going to sit with a lot of empty buildings. And
just to piggyback on that, I think this is exactly what happened in student housing about 5 or 10 years ago, because I know friends of mine that are heavily involved with universities. And what happened is the dorms, like where I stayed, no one wants to stay there.
Right.
So they came in, these developers, and they developed these beautiful places that have all these amenities, all these cool things, a coffee shop downstairs, the gym, all that. And they charge a premium, but that's where all the kids want to go. Even if they're going more into debt, or the parents are going more into debt, they want to stay at the cool place.
Right.
So they attracted all these kids away from the old beat up dorms. And I think that's going to happen in the office space now.
Yeah. Competition is good.
Yeah.
It's capitalism.
Yep.
All right, Jim. Good to see you.
Good to see you.
Thanks for listening to the Make Rich Real podcast, where $1 million businesses meet billionaire strategies. Please note the following disclosure. This podcast is provided by Do Wealth Management, an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or training. The information presented in this podcast is for educational and informational purposes only and should not be construed as personalized investment advice, tax advice, or legal advice, or a recommendation to buy or sell any security. Nothing discussed in this podcast constitutes a solicitation or offer to provide investment advisory services to any person in any jurisdiction where such solicitation or offer would be unlawful under the securities law of such jurisdiction. All information presented is believed to be reliable, but is not guaranteed for accuracy or completeness. All investing involves risk, including the potential loss of principal. Past performance, if mentioned, is not indicative of future results, and no investment strategy can guarantee profit or loss. Any mention of specific securities, investment strategies, or market performance is for illustrative purposes only and should not be considered a recommendation. Economic and market conditions are subject to change, and any opinions expressed are currently only as of the date of this recording. Before making any investment decisions, please consult with a qualified financial professional who can assess your individual circumstances, risk tolerance, and investment objectives. For more information about our services and fees, please refer to our ADV Part 2A, which is available at our website, dowealth.com, or upon request.